Happy Easter and happy tax day. Just as Jesus rose from the grave, as we celebrate that today, tomorrow the IRS rises to take your money. Welcome to Dollars and Cents, where we talk about all things related to your dollars, sort of helping to make some sense out of all of those different decisions, right? My name, of course, is Joel Garrish. Perhaps some decisions that you need to make if you're looking at that tax deadline tomorrow is, I got to get my taxes done. Well, we're going to have, as you might well imagine, a little bit of a tax bend to this morning's program, given that tomorrow, April 18th, is the tax filing deadline. First time in 3 years where we've all had to hit the normal mid-April deadline. Friday, which was the 15th, which typically would have been the tax filing deadline, was Good Friday, actually a market holiday. And so consequently, the deadline rolled over the weekend until Monday. So tomorrow, Monday, April 18th, the official last day to get your taxes in, or you can file an extension. Now, word to folks out there that file extensions. The reality is you probably want to have a pretty good idea on how much you think you're going to owe. If you're getting a refund, don't worry about it. File the extension and just collect the money later on. But if you owe, then you probably want to take at least a back of the napkin stab on how much you're going to owe, because if you don't throw that in, then you're going to get hit with interest penalties that kind of accrue at a pretty good clip if you're throwing money in after the fact. The IRS, despite the fact that it's millions and millions and millions of returns behind on the processing on their end, they really prefer that, you, on the other hand, have to get your money in by the appointed deadline. Otherwise, you'll see a bunch of interest penalties and stuff like that. So if you don't think you're going to hit it, doesn't matter whether you miss it by a few days or not. The reality is that the calculation of those penalties and interest kick in immediately. So do at least some kind of a preview as to how much you might owe, and then ultimately put that in, whether that's with the extension. You can often, if you're filing an extension, you can often sort of link your bank account. So much like you would if you're filing your return and having the refund get deposited or the amount owed getting subtracted, then you would be able to do exactly the same thing with that extension. So make sure that you are aware of that as you enter into tomorrow and have that tax filing deadline. Speaking, of course, of the folks in Washington, they are once again busy tinkering with your retirement. When you put money in along the way, putting it into 401k, IRAs, or just saving it during that accumulation phase of life, when you stop and think about it, that's really kind of relatively straightforward, right? You want to make sure that you're investing the money the right way and take advantage of tax savings where it's possible. But at the end of the day, it's sort of somewhat straightforward, that accumulation phase. The distribution phase, the sort of the exit strategy, the how to generate out income, requires a much more detailed analysis, and the depth and the breadth of the details that are necessary for that proper analysis when it comes to taking withdrawals out of your retirement accounts only gets more deeper and more detailed as the folks in Washington tinker around with your retirement. So there is a bill currently pending in Congress. It actually has already passed the House, and it does appear to have bipartisan support, for whatever that means. And it did manage, as we said, to pass the House at the end of March. That really further necessitates a little bit more detail and a little bit more depth in that exit strategy, if you will, when it comes to generating out income in retirement. And the bill, widely expected to become law, raises the required minimum distribution age from 72 to 75. Now, this would be the third time in 3 years, if I'm kind of doing the math correctly, the second time in 3 years where they've looked at raising the age. The age originally was 70 and a half, not more than 2 years ago. They raised it to 72. Now, you could very well see that age raised to 73 for as early as next year, 2023. So, let's take a sidestep and talk a little bit about what required minimum distributions are. Well, that is the amount that you are required to take out of your retirement accounts once you turn a certain age. Right now it's 72. Potentially, if this legislation passes, it will be 73 effective for next year, 2023. Why is there a required minimum distribution in the first place? Well, it's a required distribution on accounts that have been tax deferred. So that means that there's never been any tax paid on those dollars. The required minimum distribution doesn't apply to a Roth, so don't worry about it on that side of the equation. But it does apply to your traditional IRAs, your 401ks, 403bs, all of those types of accounts have that requirement. And the reason is, again, because those dollars were never taxed, the folks in Washington, hey, you know what? They'd like to get their tax money at some point. And the required minimum distribution is a mechanism that forces you to take that money, and then you have to pay taxes on it. So that's the origin of where that rule comes from. Reason, of course, they're looking at raising the ages is, well, first of all, people are living longer, number one. Number two, we do have a bit of a retirement crisis in America. There's a lot of Americans that have not saved nearly enough for their retirement. And so the notion of pushing off the age might give folks an incentive or a reason to, hey, I don't really have to take the required distribution. I want to keep working and continue to leave that money to continue to grow so that there's more of it there when I retire and start to use that money. So that's sort of the background on the required minimum distribution. Here's how you calculate it. You take the value at the beginning of the year and you divide it by the life expectancy factor for the age of which you are turning in that year. So let's say your birthday is in July, you're turning 73. That's the factor that you have to use for that calculation that you make at the beginning of the year. Now, you can take the money out at any point during the course of the year. You can take it out as a monthly income. Vast majority of Americans, in fact, do that and sort of satisfy that required distribution as part of normal retirement income that they're getting out. But you have to take it out by the end of the year. Otherwise, it's a pretty steep penalty. One of the steepest penalties on the planet, if you will, a 50% penalty plus taxes that you will have to pay if you do not take out that required minimum distribution. Now, be aware, when you're calculating it, there are new tables this year that you want to use. So make sure you're using the right tables. Those tables provided courtesy of your friends at the IRS. They take a look at life expectancies and they determine life expectancy factors that then you use as the denominator in, I think that's right? The denominator, that's the one on the bottom, D down, denominator. Yes, the denominator in the calculation, numerator, is the value of the account. Look at that. I actually remember something that I learned in elementary school. Anyway, numerator, denominator, you get the picture. Value divided by the life expectancy factor. That's how you, in fact, calculate it. And of course, if you don't take it, as we said, 50% penalty. So that's pretty steep. So here's what the bill says. Next year, required minimum distribution age going to 73. In the year 2030, goes to 74. In the year 2033, it would go to 75. When we get back, we're going to talk about why that matters. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Happy Easter and, unfortunately, happy tax day, tax filing deadline tomorrow. We're talking a little bit about some of the latest coming out of Washington, a bill that has already passed the House that would once again increase your age for your required minimum distribution. Second time in 3 years where we'd see that happen. So literally we go from 70 and a half to 72 to potentially for next year, age 73. So what are the implications of all of that? Why does that really matter? Well, we're going to get into that here on this segment of Dollars and Cents. Welcome to the program, of course. We're Central Florida's longest running radio program, coming to you on a host of radio programs throughout Central Florida. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us through your favorite podcast channel of choice. Wherever it is, you can find us. If you have problem finding us, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, there'll be a bunch of icons. Whichever one looks sort of most familiar to you, click on that one, and you'll get immediately directed over to our channel on those various platforms. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So the folks in Washington thinking about increasing the required minimum distribution age one more time. Again, why does that matter? How would that potentially change the withdrawal strategy? Because if they raise the required minimum distribution age, that means that those accounts can continue to sit there, can continue to grow on a tax-deferred basis, giving people an incentive to maybe leave the money alone for a little while longer. But, and this is a significant but, you may not want to do that because you now then would have a shorter period in which to withdraw that money, right? If you push it off until your required minimum distribution age, and they keep pushing out the required minimum distribution age, particularly if by the year 2033, the bill says it could be 75, that's a pretty significant push out in terms of the age at which you've got to take that required distribution. And ultimately, I mean, that then is a shorter period, right? I mean, if you start at 75 versus start at 70, chances are, if it's starting 5 years later, well, yeah, that's a shorter period in which to withdraw the money out of a retirement account. Okay, so that's one point, right? Second point is, lest we forget, and certainly we've been talking about this extensively on the radio program over the course of the past 2 or 3 years, the Secure Act, passed January 19, single biggest change to your retirement in over 2 decades, maybe 3 decades, maybe 4 decades. The strategy for retirement withdrawals has now changed where folks need to be thinking about that almost intergenerationally. Because what the Secure Act did, that single biggest change to your retirement, is that when you inherit a retirement account, you have 10 years in which to take all of the money out. That, my friends, accelerates the distribution of that money to a very short period of time, especially relative to whatever the required minimum distribution would be, right? Let's say you start your required minimum distribution at age 73. Good Lord willing, right? Actuarially speaking, you probably got another 20 years to go. Well, that's a longer period of time of which you get to spread that out. And consequently, if you're spreading money out or you're spreading income out over a longer period of time, guess what happens? You wind up having a lower tax rate on that money, right? Versus if, oh, wait, now you've got to take it out over 10 years, chances are there's a pretty healthy chunk of that that's going to be taxed at a higher rate than if you took it out over a longer period of time. So you see how that works almost against you. If you shorten the distribution period of time, you push out the required minimum distribution age and you think, oh, well, I don't have to worry about that. I'm not going to do it. Well, that's fine, but you're shortening that period of time. And then if we layer in the Secure Act that says, oh, it's 10 years and you've got to take all of that money out, well, that changes the analysis. That changes the exit strategy, if you will, as it relates to where and how you generate out income in retirement. Because you now almost kind of have to think a little bit intergenerationally, right? Or what makes sense from a tax perspective? Do I maybe leave my retirement accounts to charity and focus on leaving my after-tax accounts to my children and grandchildren? What's the tax bracket that I'm in? What's the tax bracket that my kids are in? What's the tax bracket that my grandkids are in? These are the kinds of things that you need to think about when you're thinking about retirement accounts, because here's the deal. This generation that is age 65 and over represents really the first generation where there are sizable retirement account assets, because that generation, 65 and over, is really the first generation that saw their pensions go away. And so they had no choice but to fund money into retirement accounts, 401ks, IRAs, things like that. So this generation, this is really the first generation where we've seen this massive amount of wealth in retirement accounts that then is going to pass to the next generation. And that's the point of what the Secure Act was at, and which is why we describe it as perhaps the single biggest change to your retirement in over 2, 3, 4 decades, even in that. It shortens that distribution period of time. Do you use more of your retirement accounts now rather than your after-tax accounts? You know, traditionally the strategy was, I'll use the after-tax accounts, reduce my taxes, because that has less tax basis in it, and that's what I'm going to do, and then I'll save money on my taxes, and then I'll just pass the IRA on to the next generation. Well, not so much anymore, right? If the next generation is going to take it out over a 10-year period of time. Do I perhaps look at whether I should be doing a Roth conversion? Certainly something that's gotten a lot more popular, but remember, you can't convert your required minimum distribution to a Roth. Don't forget about that. It's not like you can take the required minimum distribution and then turn it over to a Roth. You can't convert that RMD to a Roth. And then from a charitable perspective, certainly the notion of a qualified charitable distribution, particularly when it comes to your required minimum distribution, is a great way to give to your charity and to get an immediate tax deduction on that gift. And here's why it's important. 90% of Americans don't itemize anymore. So when someone comes in and says, I'm making a gift to charity and it'll help me on my taxes, the answer is, probably not. But if you do a QCD, it absolutely will. Every single time, no matter what. So if you've got to the required minimum distribution age and you are charitable minded, then it certainly makes sense to give that charity a gift directly out of your IRA. Now remember the rules there. It's got to be made payable to that charity. You can't take it and then write the check. It's got to be payable from the retirement account to the charity itself. So certainly some things to be thinking about in terms of withdrawal strategies and retirement accounts. We're going to take a break and return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Happy Easter and happy tax day. Boy, what a tough combination at the end of the day. You know, interesting, we were talking about the notion of QCDs, qualified charitable distributions, to use those as part of your required minimum distribution. Shoot, maybe you should have done that today, right? Easter, you're in church, okay, that's a charity. So if you had your RMD, rather than just writing a check out of your checking account to the church, you could have done it as a qualified charitable distribution. Yes, there are some rules, of course, that you have to follow on that, meaning that the IRA custodian has to make the check payable to the charity itself. It can't make it payable to you and then you write the check, but certainly a great way to ensure that, yes, in fact, you do get a tax benefit for that charitable contribution. Welcome to the program. This is, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. This is Central Florida's longest running radio program, coming to you on a variety of radio stations throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So, given that tomorrow is tax deadline day, as tax season winds down, we thought it might be interesting to sort of reflect on some of the bigger changes that we saw. And of course, for those who haven't yet filed their returns, maybe they will glean something from this part of the conversation where they say, I need to do that on my return. And of course, probably the biggest changes for that 2021 tax return that is due tomorrow is another round of stimulus checks. This is, of course, the second year in a row where you had to deal with stimulus checks on your tax return. The biggest issue there, we saw this constantly, actually talked about it on the radio program last week, is the notion of folks actually tracking down and figuring out what the amount of their stimulus checks were, and more importantly, whether they got it or not. That was probably the biggest issue that folks had. I doubt we'll see another round of that. Boy, I hope we don't, because at some point somebody's got to pay for it. There is no free lunch in America. There is no free funds. At some point, somebody is going to have to pay for it. The typical family of four, mother, father, a couple kids under 6, got about $5,600 from the stimulus check last year. If you didn't get it and you become eligible for it, then there's a mechanism on the tax return in which to be able to have that amount come onto your tax return, and then you can claim it that way. Number 2 is the expanded child tax credits. Again, this one was sort of as opposed to a stimulus where we saw that a couple in 2020 and then another one in 2021, the additional child tax credit payments was really a one and done for the year 2021. And what that did was the typical child tax credit for a child under age 16 was $2,000. It got bumped up to $3,600 per child under the age of 6, up to $3,000 under the age of 17. So much greater expansion of those child tax credits. That is gone, or at least at this point, gone for the year 2022 and going forward. That was really kind of a one and done. But if you're keeping score, and again, that family of 4 with 2 kids under 6, well, that's another $3,200 that you would have gotten beyond what the normal rules were. So if you're adding the $5,600 stimulus check, you're adding the $3,200 additional child tax credit, you're up to $8,800 of extra cash that family of 4 in America, making probably about $120,000, so about $10,000 a month. So not, decent enough income there at $10,000 a month. The reality is that there was an $8,800 transfer of money from the federal government to that typical family of 4 making $120,000. A lot of money, especially when you then layer in the expansion of the child and dependent care credit. This one also one and done for the year 2021. But what this did is that you get a tax credit, and this has always been the case, but they expanded it pretty dramatically. Previously, the credit was 35% of the first $3,000 in expenses per child, up to 2 kids, for money that you would have spent for like after school programs, things like that, while the parents were working. You've got to put the kids somewhere, hence the name. It's a child and dependent care tax credit, meaning that you paid for care and then you get a tax credit on your return. So this year for 2021, it expanded to be at 50% of up to $8,000 in expenses, or a $4,000 credit, and up to 50% of $16,000 that was spent on 2 kids, so up to an $8,000 credit. So literally, it went from a maximum credit of $2,100 previously to a maximum credit of $8,000. If you're keeping score, family of 4, 2 kids under 6, guess what? That's an extra $5,900. Add that to the stimulus checks, add that to the expanded child tax credit, and that's a total payment from the U.S. government. Family of 4, $120,000, 2 kids under 6, because at 120,000 you would have been below. You would have been eligible for all of these credits. That's a total payment of $14,700 in 1 year. Think about that. Anyway, that's a lot of money. So, I'm not sure who's going to pay for that, but apparently they got it all figured out in Washington. When you start to add the numbers up in terms of the tax changes that we saw for 2021, and in terms of the expanded tax credits and the expanded child tax credit and the expanded dependent care credit and the stimulus checks, you add all of those up, and it is a crazy, crazy number that was sent from the government out to Americans. Anyway, kids and grandkids, good luck on that. There ain't no free lunch. Anyway, those were the big changes as we reflect upon tax year 2021. It's funny. I started adding these up, and I was like, it just blew me away. I don't know. Maybe you don't feel that that's that much or what, but you add them up, and it's like, wow, that's a lot. That's a lot. Anyway, stimulus checks should be gone for 2022 and going forward. The child tax credit stuff should be gone for 2022 and going forward. And the dependent care expansion, that expanded credit should also be gone for 2022. So again, reflecting on 2021 tax return that is filed or is due to be filed by tomorrow, and just sort of thinking through a lot of those big changes that we saw, and ultimately the material impact that they have. So those are, of course, some of the big three. Similarly, another one and done had to do with the coronavirus-related distributions from your retirement accounts. That was the one that waived the penalty for early withdrawal of up to $100,000 out of your retirement accounts, and also proceeded to let you spread that out over 3 years. So on your 2021 tax return, you had a third of that amount coming in. On your 2022 tax return, you will have the last third of that coronavirus-related distribution coming on in. So understand that if you did that, you've got one more third to go for the year 2022. But that was a one and done in the year 2020. Similarly, another one and done in the year 2020 was the tax-free nature of the first $10,200 of unemployment benefits that you wound up receiving during the course of the year 2020. So that one also sort of a one and done. So you wouldn't see either of those two on your 2021 tax return or tax returns going forward, with the exception of the COVID distribution. If you're spreading that out over 3 years, then you got one more year to go of a third of that to show up on your tax return. We're going to take a break. When we return, we're going to continue some thoughts and reflections on the 2021 tax season that was, or soon will be, in the was category after tomorrow, here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. Doing a little recap here on Easter Sunday morning of the tax season that was, or soon will be, because tomorrow is the tax filing deadline. We hope that you and yours are enjoying a wonderful Easter out there. We are talking a little bit about those big changes that happened in 2021. Some of the ones that are sort of a one and done. A lot of them are in the category of one and done. And frankly, if you were listening to the last segment and heard me total up how much money a family got based upon the tax changes, you would be scratching your head as to how on earth, trying to make sure I be clean on Sunday morning, how on earth we're going to pay for all of that. Family of four making $120,000, using the maximum benefit of the expanded child dependent care tax credit, along with the child tax credit, along with the stimulus checks. $14,700 is what they would have received during the course of 2021. If that seems like a lot, I would agree with you. If that seems like not enough, well then, I'm not sure I agree with that assessment. Anyway, we will talk a little bit more about some of the other tax changes that happened for 2021 and reflect on what goes forward and what doesn't to the year 2022. So we'll shift gears to charity, right? Appropriately enough, on a Sunday morning, maybe you're going to church or coming from church. That's a charity. What's a good way to get that money over to them and get a tax benefit? Well, as we talked earlier in the program, the qualified charitable distribution, if you're having to take a required minimum distribution from a retirement account, well, that's always a good way to do it, because that way you assure yourself that you're going to get a tax benefit for making that charitable contribution. Similarly, there's also an additional charitable contribution that you can make as part of the standard deduction. For single filers, it's $300. For married couples, it's $600. So yeah, that doesn't sound like a whole lot, but at least it's something. That has to be a cash contribution in order for you to properly claim that credit. That one does continue going forward for 2020 and for 2021. So this one is gone, did not renew for 2022, at least at this point it has not. If you wanted to make a larger charitable contribution, you could. There was no limit on the ability to make charitable contributions in the year 2020 and 2021. This one has one more year. This was a 2021 and 2022 ability to, when you're using and doing business lunches or business dinners or anything like that, traditionally you would only be able to write off 50% of that meal cost on your tax return. For this year, it becomes 100%. And also continues on for the year 2022. So important to know that as well, where you get to write off the full amount of those meals versus just only 50%. That 50% limit returns for the year 2023. Also for this year, of course, as usual, slight increases in the contribution limits for retirement plans, 401ks, 403bs, 457s. Unfortunately, no real change in the contribution limit for IRAs, but for 401ks, 403bs, 457s, that contribution limit did go up $1,000 to $20,500 for the year 2022. And then if you're over 50, still another $6,500 of a catch up that you could do on that. So a total amount of $27,000 that you could shelter in those types of plans. And then lastly, of course, cryptocurrency. This one not going away anytime soon either. IRS obviously sees an opportunity to generate tax revenue, so it's looking for a much greater amount of reporting and transaction reporting. Certainly the requirements in terms of generating out cost basis information, those kinds of things, is starting to apply to the cryptocurrency side of things. So just be aware of that as it relates to your taxes. So that's kind of the overview of some of the changes that we saw for 2021. The fact is that some of them, or a lot of them, don't carry forward. They were kind of a lot of one and done type of thing as a result of COVID. So hopefully you're able to get your taxes done and get them filed by tomorrow. As we said, if you're not able to do it and need to file an extension, make sure that you at least think about, okay, wait a minute, do I owe money here? Because if you do, then you got to throw money into the IRS so that you don't get hit with a bunch of interest and penalties. So make sure you do that. In other news, about a week or so ago, we did another blog post on our website. So we encourage people to go to our website, nelsonfinancialplanning.com, and check out our blog. If you go to the page, it's sort of the middle kind of row of buttons in the middle there. It's like, it says blog, so click on that. And you'll see our topics for this month. So every month we usually do a blog post talking about a variety of topics. This month's had, as you might well expect, a little bit more of a tax flavor. So in that, we talked a little bit about 1031 tax exchanges. And remember, that's a way of deferring your capital gain when you sell a rental property or other real estate investment, so you don't have to report and pay it all on the current tax return. You can kind of defer it or pay it over. The reality is, though, that there's a lot of rules associated with that. and you need to use a qualified intermediary for that exchange in order for it to be a proper exchange. And the property that you're buying has to satisfy the like kind requirements of the 1031 exchange rules, meaning that you can't sell a commercial building downtown and buy a residential property over at the beach. It's got to be sort of a like kind type of exchange, along with 3 key rules that we talk about in the blog post. Number 1, replacement value, replacement property should be of value at least or greater than the property that was sold. Some exceptions to that, but that's certainly a good general rule. Similarly, you must find the next property within 45 days of the sale of the prior one and close within 180 days. So definitely some tight rules on how 1031 exchanges work in order to get them to properly work for you on your tax return, to be able to defer whatever that gain is on that investment property. And then, of course, in that blog post we did a week or so ago, we included the top do's and don'ts for your tax return and tax return season. We've certainly talked a lot about that in the program. Of course, track down those stimulus checks, track down those advanced child tax credits. Make sure you're figuring out your IRA contributions, your HSA contributions. Still not too late to fund those, by the way. You have until tomorrow to do it. So it's getting tight on the deadline, but know that you can still fund those. And then make sure you're taking advantage of that extra charitable deduction as part of your standard deduction that you are allowed to do. So those are sort of the do's. The don'ts are, don't expect a refund anytime soon, although so far this season, we've actually been seeing those refunds come in a somewhat regular, timely basis, or should I say timely for the IRS. So at least that seems to be going a little bit better. Still, the IRS very far behind in terms of returns. The call volume, the 800 numbers of the IRS, don't even bother. That's still way far behind. That certainly has not changed. And then most importantly, because this is the first time in 3 years where we are back to the normal deadline, make sure that you hit that mid-April, which is tomorrow, the April 18th deadline for the filing of your tax return. A lot of the COVID stuff, as we've been talking about in the program, all of that disappears. A lot of one and dones on that. So that's the recap and reflection on the tax season that was in the year 2021. Hope you have a great Easter Sunday here on Dollars and Cents with Joel Garris of Nelson Financial Planning.